Welcome to Barchart's educational series of webinars. Today's topic is about understanding and optimizing Barchart's futures trading guide to navigate futures markets and make informed investment decisions. We'll be taking an in-depth look at the features of the guide and how to help you recognize longer-term trends. In addition, I'll be sharing some of my insights how to better time your entries and position pyramiding to maximize profits. Now, whether you're new to futures or an experienced futures trader, I believe that you'll find today's session will be filled with invaluable information. So get ready to take some notes and learn how to take your futures trading game to level. Hello, everyone. My name is John Rowland, and I am Barchart's Head of Trading Education. And as I alluded in the opening, today's session will revolve around Barchart's Futures Trading Guide, which is a trend-following system. We're going to discover the advantages and disadvantages of trend-following systems and ways to enhance our results. Now, before we get to that, please welcome my partner and our moderator, Barchart's Project Director, Jean Baker. Hello, Jean.
Hi, John. How are you doing?
I'm doing fine, and yourself?
Good, good. I hear you have a packed session for us today.
We do. We got a lot of stuff to get to, so no dilly-dallying today.
No, we're not gonna chit-chat too much here. I'm gonna let you get right into it because you have a lot to cover. So
Thank you very much. All right, so let's get this ball started. All right.
Sounds good.
So just a reminder that today's session is for educational purposes only, and decisions to buy, sell, or hold any security, commodities, or other investments involves risk and best made on the advice of a qualified financial professional, and that futures trading involves particularly high risk. It can cause you substantial sums or losses of sums of money. And under no circumstances shall we be liable for any loss or damages that you or anyone else incurs as a result of any trading or investment activity that you or anyone else engages in based on information or material you receive through barchart.com and our services. Okay, so where do we get started on this one? Well, it's pretty easy. Whoops. If I was on top of my game. Is we're going to start on our futures trading guide page. If you don't know where that is, under futures trading guide. Now, I'm just going to mention here at the top, and then Jean will definitely reinforce this later for me, is this is one of our premier features. There are some capabilities for those who are free traders, free accounts to look at, and we'll talk about that a little bit later. So what is the futures trading guide? Well, it's basically a hypothetical trading system that takes a buy position based on when the shorter term 9-day moving average crosses above the longer term 18-day moving average. And then it takes a sell position when the 9-day crosses below the 18. Now, the profits that will be resulted in the trade are based on the point value of one futures contract, and that is from the last price compared to the settlement price on the start date of the signal. So there's a couple points here. First is that this is a trend following system. In other words, it's based on price movement of these two moving averages. Two, the results that you're going to look at on this page are based on one futures contract. Three, the date of the crossover signal uses the settlement price on that signal day. Now, in our demonstration today, we're not necessarily going to take a trade on the day of that signal, but we're going to use that signal as permission to find an entry with that signal. Even if that entry is delayed by days or weeks, depending on how long and strong this new potential trend becomes. Now, what are some advantages of a trend following system? So the first one is simplicity, that we just wait for the system to identify a new trend, and then we take a trade that is with that trend. The second advantage is time management. It just provides us an entry and an exit. That's it. It's not very complex. And so for somebody who doesn't have a lot of time to trade or watch the markets on a day-to-day basis, this trend following system is it's very easy to do. And the third, robustness. Now, what does this mean? Well, because trend following systems don't really try to predict market direction, it's just telling us, is our market trending? And so then allows us to be less affected by this noise or this intraday market volatility, right? As long as our market is trending, right, then the system is still working. Trend's your friend until the bend at the end. And then the final one is really the greatest, and why we trend trade to begin with, is that it works in both market conditions, bull and bear markets. And because we're trading futures markets, it's a lot easier to take short positions, unlike in stock market. But it also helps us discover these fat tail events, these trends that last for long periods of time. Now, these are going to generate large profits, which is going to help us offset some of the disadvantages and risks of trend following systems. And what are some of those? Well, the first one is that trend following systems do lag. And typically, what we might see is that we'll see an impulse in price, which means we might miss out on some of the potential gains. But this also increases our initial risk. This is where I'm going to try to show you how to maybe a delayed entry might help us to mitigate some of this initial risk. Not necessarily always, but maybe on a probability basis. And that might allow us to recapture some of the later gains. Now, lags also for exit signals, and this could lead to some systemic losses. Trend following systems create a lot of false signals, especially when we're in choppy or sideways markets. Again, using a delayed entry will potentially eliminate a few of these entries, but certainly could lower the dollar risk of a false signal. And then finally, this is the part of trend trading and trend following systems, which I call the nature of the beast. That trend following systems can experience considerable and long periods of losses, and this is known as a drawdown. Now, for some traders, this can be very difficult, personally on the emotional side, but also on the financial side. Unfortunately, there's no way to mitigate this risk without some type of risk management, which means that we might stop ourselves out of a trade just before that trade becomes profitable. Remembering that we want to try to stay in the trades as long as we can so we can capture these fat tail events. And hopefully these fat tail events results should outweigh these large drawdowns. But I kind of call this that trade-off of a trend following system. Do I feed the beast or do I fight the beast? Okay. So here I'm back at the futures trading guide. And so, like a lot of our data table pages, we just from left to right, let's go across a couple of some of these. First of all, here's your symbol, your contract specific symbol, the contract and the month of the contract, the last price of the contract, how much has it changed from the previous day, our current futures guide signal, in this case for corn, the signal is a sell or a short signal. Strength. Now, I'm not going to go into a lot of detail today on strength. If you want a deeper detail of how to use strength in your analysis, in the previous futures trading guide webinars, I go into a little bit more detail. But we actually have a a webinar that is called Strength and Direction, and we go into the details of how to use this in trading. So you can find that in the archive of webinars. The start date, the crossover, when those two moving averages cross over, the entry price, the settlement price on that signal day, our current profits. In this case, you can see that red is bad, that's a loss, and green is good, that's a positive. And then trade details or detail view details. So if I click on this link, this is going to open up a wider array of data for us. So first of all, you'll get the current position, which is a sell or short. Again, the entry date, the entry price. How much has price moved from that entry price? Again, here you'll see that green and red. If I have a red color, that tells me that price has moved against my position, and then it calculates the profit or loss. And then days in the trade. Now, this is going to be significant to us in a moment. Excuse me. And then in the aforementioned strength and direction. We get a little bit of a chart that shows us what is going on in our signal. And, I can do some manipulation on it. I can't draw any lines or do any studies on this. I just can look at this. And the purple and blue lines here represents our 9 and 18-day moving averages. Now, I want to remind you that this system, this trade, is always in the market. The futures trading guide is always in the market. So a sell signal is an exit from a previous long position, but it's also an entry to go short. A buy signal is the exit of a previous sell signal, but also an entry to go long. So in the current signal was a sell signal, which was an exit from the previous long position, but also a entry to be short. Now this is called a stop and reverse system. Below there, we have our futures contract specifications. Again, there's some important risk information in here. For instance, our point value, our margin, our maintenance margin values, expiration dates, and first notice. Now, if you are kind of new to futures trading, you might ask the question, which one's more important, expiration date or first notice date? And just realize that we can't hold futures contracts forever. They do expire. And so which one is more important? Well, it would be the date that comes first. So in this case for corn, the more important date for us is the first notice date, which is February 28th, which tells us that at or about or before that date, we'll need to exit this position. You get a little bit of technical analysis. Notice that ATR is in this, and ATR is a very versatile tool in trading, and it certainly is one that I use in my futures trading. Again, if you're interested in how to use ATR in futures trading or in any trading, I do have a webinar called ATR, the Swiss Army knife of technical analysis. But in some of my other futures sessions, we do talk a bit about ATR. Then we have our trade history, which is the number of trades that have occurred in the past year. Notice in this case, we have 12 trades. And then the average days that were in the trade, in this case, 30 days, and then the total profit of all 12 of the trades. Now below that, it breaks down the 12 trades into winners and losers and longs and shorts. So you can look at that. Now, if you want more detail about each individual trade, you go here where it says view trade history. Now in here, it breaks down each of those individual trades, the winners and losers. What you do is you see these little arrows here. You can click on the arrow and it'll bring up a chart that shows you the price action of the chart with the moving averages on the days that created those signals. In this case, this was a buy signal. And then here was the sell signal that was created as the moving averages crossed back. If you see OTE, that means open trade equity, and that trade has yet to be closed. And that's the current trade that we're in. Now, what I want you to do on this page, though, is take notice of the days in the trade. Notice how that the lower days in trades are typically the losing trades. Not always, but typically. And that the longer days in trades are the winning trades. So this is kind of reinforces what we're going to learn throughout today's process, that the futures trading guide is a lagging indicator and that we're trying to find these fat tail events. And so there's no rush to get into the market, right? We're in it for the long game. The other thing I want you to take away from this page too is the hypothetical profits. And the one that I want you to really focus on is the drawdown. So notice that the drawdown does tell us how much that price or went against us from the entry price before we were either stopped out for a profit or a loss. What we'll do here is we'll look at the maximum drawdown here. That's a high water mark of risk. Can I afford to trade this market? Do I willing to take this amount of risk per the contracts that I'm going to take? So this is really kind of a measuring tool for us, a tool that helps us determine volatility in a dollar value, that max drawdown. Excuse me. All right, so let's go back to our futures trading guide. And what do we see here in corn? Well, first of all, you can see since October, we've gotten a lot of signals. And what is our moving averages doing here? They're kind of just jumping back and forth. So again, one of the things about trend following systems in sideways markets, you get a lot of signals, and a lot of them are bad signals or false signals. Now, I don't know what's going to happen in the next few days, but the fact that both of my moving averages are turned up and that price is above both moving averages, even though we have a sell signal, I'm pretty confident that in the next few days, we'll probably get a stop out or a new buy signal. Now, that's not necessarily it's going to happen, but it does feel like that is going to happen. Right. So let's look at a futures trading guide trade that is in a trending market so we can get a little bit more sense of what we want to do. So I've picked soybeans here, and you can see that this trade was established on December 1st. Currently, it's a buy signal, meaning we want to be long, and that here was our entry price, 14.36 and 6/8. And that trade is now up about $4,000. So if I go to the trade view and I look at that most recent buy signal, so again, trend following systems have this lag effect. And so here you see that impulse in price, a little bit of an uptrend that created this buy signal. Now on the buy signal day, right, what did price do? Well, it fell back below our moving averages, not giving us a lot of confidence in this buy signal. But this is where a delayed entry may play into our favor. Okay, so let's see where I want to go now. Okay, Some of you might be familiar with some technical analysis, and I've gone into our Learn page under our technical analysis, our technical indicator libraries. And some of you are familiar with relative strength index. A relative strength index is a momentum oscillator that helps to find overbought and oversold areas. Some of you might also be familiar with stochastics. Fast or slow, doesn't matter to me. Again, another momentum indicator that is going to help us identify overbought and oversold conditions. But I bet a lot of you are not aware of a technical indicator that's called the stochastics RSI. Now, what is this one? Well, it's exactly what it sounds like. This is a stochastic of RSI. So in the book, New Technical Traders, Chandlin and Kroll explained that the RSI sometimes will stay between 20 and 80. In other words, you don't really get an overbought or oversold signal in the RSI. And that might leave you on the sidelines until you get those signals. So they created this system that is going to be a little bit more sensitive to price movement and help us identify over and bought levels based on the RSI. What we're going to do is we're going to use the common interpretation of this to help us create our entry signals. Now, the first signal that we're going to look at, and the one that we're going to rely on most of the time, is an overbought or oversold crossover signal. So if we have identified an uptrend in an underlying security, our futures contracts, we're going to look for a buy signal that will be generated when the stochastic RSI advances. Here it is, oversold 20 and advances above the 20. So go from oversold to giving us a buy signal. And conversely, we'll look for an overbought above here, above our 80, and then below to give us that sell signal. Now, what we're going to do with this is we're going to take this signal and we're going to add a little twist to this. What we're going to do is we're going to drop down from our daily time frame of our futures trading guide, moving averages on 9 and 18, and we're going to go to an intraday time frame. I'm going to use 60 minutes. And what we're going to look for is that contrarian price movement. In other words, if my futures trading guide is showing me a buy signal at the 60-minute time frame, I want to find an oversold condition. In other words, I want to see price falling, a contra price action to our higher time frame, our futures trading guide signal. And vice versa, I'm going to look for a rising market in the 60-minute time frame, overbought condition in a sell futures trading guide. Now, the other signal that we can use is called the centerline crossover. This one is a little bit more conservative, again, a little bit more delayed, but it is as effective as the overbought and crossover signals. Okay. So let's go back to our soybeans futures. And on the day, here was on that day where we got that buy signal. Notice it's December 1st. What we're going to do now is we're going to drop down to a lower time frame. We're going to look at that 60-minute time frame. We're going to look at that chart with those indicators and look for an oversold condition. All right. So what I've done here is I've created a chart already for soybeans contract, and I notice that I'm using 20 days and 60 minutes. 60 minutes is the most important. It doesn't matter how much data you use, just that we're on a 60-minute time interval. Now, don't get confused here, but here's our RSI, here's our slow stochastics, and here's that stochastics RSI. I've added these all to the chart. If you're not familiar how to do that, you do that through the studies. You can add that. But what I've done is I've created a template. Again, there's some tutorials how to do that. And I have an RSI stochastic template, so I don't have to do this every time I go to a new chart. I can just pull up that template, and then it contains those 3 studies. All right. So let's go back in time. And here we are. Here's our blue line that represents the day of our futures trading guide indicated that buy signal. Now, if you look up over here to the left, notice that it does say December 1st, but this was at midnight, right? As we move from December into December 1st. The futures trading guide signal is produced at the settlement price for that day, and that wouldn't have happened to about here, right around 1 o'clock. So that would have been the price that the signal would have taken. But again, you can see this price impulse was to the downside. And again, I would not have a lot of confidence in this trade at this moment. But if I'm using the futures trading guide and I'm starting to use these technical indicators, especially this stochastic RSI, what we're going to do now, we're in the 60-minute time frame, we're going to wait for an oversold condition in the 60-minute time frame that is in this uptrend or this buy trend. And you can see that from this point forward, there we got that oversold condition. There it is. And then we wait for it to pop back above, and that would be about where we would enter into the trade. Again, delaying our entry, again, taking away a little bit of potential profit. Now notice that the stochastic did get too close to oversold, but the RSI did not. That was kind of the basis of creating this study. All right. Delaying our entry in order to get better conditions. Now notice though that our entry here is a little bit higher than the entry of the futures trading guide. Now what I might do as a risk management is I might come in and say, okay, here's my entry, and now I'm going to risk the low, in this case because we're buying, of the impulse that created our signal. And now I know how much risk I'm going to be taking on this potential trade. So what's the next thing we can do? Well, we could delay our entry until we get a greater confirmation. Now let's go back to our futures trading guide. So now I'm looking at this chart and I'm saying, hey, you know what? I like the idea of going long soybeans, but maybe I want to wait until price recaptures my moving averages. Wait until it gets above that. And that happened on December 6th. So there's December 6th right there. Again, this is at midnight. What I'm going to do now is I'm going to wait for that oversold condition in the lower time frame. Give me permission to come back into this trade. And you can see that we got a couple little bounces here, but really here's where it really popped out. And again, this is where that center line confirmation. So I'm getting a lot of, bouncings out here. I'll say, all right, now I'm going to wait to get that crossover signal, but maybe I'll wait for the center line to really give me that real confirmation once we captured that center line. And that would have been an entry somewhere around here. Again, when price is above our future trading guides moving averages, the greater confidence that we're now in an uptrend. The third way we can use this to delay an entry, and again, based on probability and confirmation, is we just use old school technical analysis in terms of how we look at trends. So what is an uptrend? Well, an uptrend is a series of what? Higher highs and higher lows. But what I might want to do is wait for price to break above a previous high that was set before the signal was created, and that would have been this high here. So now I'm going to wait, delay my entry until price gets above this previous high. I make a new high, and then I'm going to wait for those oversold conditions in this lower time frame. And there you can see there's the oversold condition. Matter of fact, we got it in the stochastic and the RSI. We'll wait for that price action to push these indicators outside of the oversold, giving us a common interpretation of a buy signal. Again, delaying my entry, taking away some potential profits, but now I'm gaining greater probability in terms I'm more confident that I'm in an uptrend because it just made a new higher high and I'm buying into that recourse or that correction of that recent impulse. Okay, so this was a bit of a mouthful, a little bit of a complex idea about trend analysis, but I think for some more intermediate and advanced traders, you'll understand this. But those of you who are new to this process, so what I'm going to do here is I'm going to show you something, and I'm going to deviate away from the Futures Trading Guide page for just a moment. And under the news section, there is featured authors, and one of the authors that I'm very fond of, he's a friend of mine, is Don Dawson. And in Don, I asked Don over the weekend, I said, hey, Don, could you write an article, and shout out to him for doing this for me, basically talking about this process that I just talked about, which is understanding trend analysis, right? We've already discovered a moving average, right? Moving average found the trend. What do we do now? And so in Don's article, he breaks this down again for you. So this is a reference for you, so you can go back. So here is gold, and Don used the 9 and 18, the same that we use in the Futures Trading Guide. 9 represented by the blue line and the 18 by the red line. And again, trend analysis, right? We have downsloping moving averages. That's telling us we're in a downtrend. We have sideways and fluctuating, sideways action, choppy, no trade to be taken. And then we see our moving averages turn up. Again, maybe we will wait for a greater confidence in this uptrend when price breaks a previous high. So notice here that our crossover came on November 7th. And so that's what Don does. He goes in and he breaks this trade down for you. He says, okay, we've got an uptrend. And what I'm going to do is I'm going to wait for price to break above a previous high, what I just did with the soybean trade with you guys. And we're going to wait for it to make a new high. And then we're going to see for price to come back, a correction. And this is old school technical analysis, right? Resistance that is broken now becomes new support. And so we would wait for price to correct, retest the resistance, which has now become new support, re-engage our moving average, and take a long trade. What we're going to do is the same thing. We know that we're in an uptrend because of the Futures Trading Guide, but here's where we're going to use that technique with our oscillators. Okay, so let's go back to this. Actually, let's do this first. Let's go back here a second. Need to do a little referencing for you. All right, so this high was on October 4th, and our resistance line here is around 1750, right? And then our entry came just at the end of November. All right. So here's gold, and let's go back a little bit in time. There's our November 7th, that was the date the Futures Trading Guide created that new buy signal. There's that high on October 4th. Again, we're going to delay our entry until we gain greater confidence. Right? We want to see price take out that resistance. There it is right there. Make a new high. We wait for the correction where we retest the previous resistance, which now becomes new support. And then we wait for those conditions that'll give us that opportunity. Now, notice as we came close to this support line, we did get a signal here. We did get it in the stochastics and in the RSI, so that would have been a great opportunity to get in this one. But if you notice here at the bottom here, this was at 4 a.m. So for futures traders, here's a couple of thoughts here for you. You know, gold is a 24-hour market, and from my experiences, you will find a lot of great signals in gold around that 3, 4 o'clock in the morning. Why is that? Well, that's the beginning of the European market. So if you want a little bit more detail on that, I have written, have a webinar which is called Timing Futures Trades with a Clock, which I break down this idea of global markets and openings and closes around the world. So I recommend that you do that. But let's say you're not up at 4 o'clock in the morning to take this trade. Notice that we did get, again, we're in this for the long run. We don't have to rush to get in. We did get that same oversold condition. This came during the US market, right around, looks like around 1 o'clock. And again, right where we have already tested, or right on that support line. So that would have been a great opportunity to re-engage that uptrend. Now, Don's article goes on a little bit deeper about talking about, you know, when you come into an area of consolidation or you have multiple areas of resistance, and that's what we see right here. And again, we're going to wait for that breakout, right? This is more of a breakout trade style. We wait before we break out of this ranging area, and then we wait for that retest to come back and test the breakout zone and re-engage our trend. Again, here we can look at our oscillator down here, and there would been where we would have gotten that buy signal. Again, our RSI was oversold, and so was our stochastic. So right about in this area. And again, this one was during the New York hours. Looks like about 1 o'clock in the afternoon. So again, our way to engage this uptrend. So those techniques, what I'm showing here is, here we could say we're just waiting for confidence in terms of the trend, but also as my trend is developing, as it is coming to these areas of breakouts and coming to these areas of corrections and after impulse moves, this is also an opportunity to add on to my positions. So that's what I want to do next. So what I've done is I've created a portfolio here. And if you're not familiar how to create a portfolio, it's really easy. Just go into the portfolio here, add a new portfolio, and you can name it. I would recommend that you would send that portfolio to you at least at the end of the day. Now, for demonstration purposes, I use the default for detail view in my portfolio, and that's what's going to give me the details of the trade. So here's that initial gold trade that the Futures Trading Guide created. And if you don't know how to add a trade, just go here where it says add transaction. You type in the symbol, and whoops, there we go. And then you would fill in the details. What I wanted to kind of point out here is look at the notes in the low flag and high flag. This is another way we can help us in our trading analysis. So here is that original trade, And if I go into my edit my notes, one of the things I like to put in notes is I like to put in the date that I need to be out of this trade. In this case, for gold, it would be our first notice day, which means that I need to be out of this trade by January 31st. I also put in the maintenance margin so I know how much the maintenance margin is. Now, the low flag and high flag will, in our portfolio, will create values that we're going to create based on whatever we're looking at, support or resistance. But if price gets above our high flag or below our low flag, then it will create a color signal on our profile, our portfolio profile. So I'm going to show you that. But let me show you why I choose these two dates, these two prices. The low flag on this trade was 1870 and the high flag was 1935.50. And if I go to my chart, and here we are in gold, that 1870 is the low of this basing and impulse. So this might be an area where I might do some risk management in terms of, let's say I'm in the trade, profit trade, especially if I have multiple contracts. Maybe this is, if price fell below here, this might be an area where I might take a few of the contracts off, lighten up a little bit, take a little profits. And the 1935 is in line with an area which I believe is more of a targeting area and less of a resistance area. But again, you could use both of them as that. Again, I might at that point, because I've reached a target or reached an area of resistance, that might be an opportunity for me to take off a trade. Now let's look at that first add-on. This was the November 21st trade. And again, I haven't updated this one yet, but my low flag was 1720 and my high flag was 1836. Go back to our chart, and that was that entry. There it was. Why did I pick 1720? Well, that was the low of this impulse candle where I added this new position, so that would have been my risk. That's where I would feel that if price fell below there, I'm probably wrong on this trend. And this is the impulse candle that did what? Took out that high and led to that new high. Why did I use 1836? Well, after price moved away, after a few days, then that was that high where we see multiple high levels. So at that point, is that a target for me, or is this also an opportunity to add on when price breaks out of that range? So you can see that in the futures trading guide process, even delaying our trades when we get one of these fat tail events where our trend goes on for a longer period of times, you can see that the profits start to really add up. And remember, these profits are represented by one lot positions. I did the same thing with the soybean. The first trade was the futures trading guide position, and then this was that where I'm waiting for that confidence, getting that new high and taking that position, and that, see, is the result. But it's not always winners, right? Trading is about learning how to take losses. So let's look at this crude oil trade. And let's do this. I'm going to stay on this portfolio, but this is how you can jump from page to page and come into the links, and you can go right to the trading guide. But I think I already have it up. Yeah, there it is. So what did happen here? Well, we got that impulse, right? Price fell below our moving averages, and then we got multiple days where price was below our moving average, and then we got a sell signal. All right, so far so good. All right, now we're going to wait for the overbought conditions to re-enter into this trend. So let's see, let's do this. Did I already do this one? No, okay, no, I did not. So let's blow this one out. Go to my template. There's our futures trading guide sell signal, right? So now we're going to wait till we get an overbought condition, right? And that would have given us an entry right about there. Now, we just did this whole process about waiting for a greater confirmation in trends and this idea that, sideways markets tend to give us some false indications. Now, for crude oil, this is definitely one of those more volatile markets. And in the sense of crude oil, if I looked at my price action as I'm coming into this new futures trading guide signal, what is my price action been doing? Well, it certainly looks like it's not trending. It's kind of going sideways. And so what I do here? Well, maybe I'll wait a few days. Now, from experience, for crude oil, this is definitely one of those markets that I'll wait 3 days or 4 days before I make a decision to join the trend. I don't care about giving away a little bit of that profit to be right on the top of that signal. I'm going to wait until I get a clear signal from my moving averages. I want to see them, in this case, turn down, right? Well, they're still, both of them are kind of trading sideways and actually turned up. So in this case, what would I do? Well, I wait. And what I'm going to probably wait for, just like I did with the gold in the soybeans, is I'm going to wait for the market to confirm to me that it's in a downtrend by taking out the most recent low prior to the initiation of that signal. And did that happen? No, it didn't. So I'm not even in the trade. But let's take the assumption that we did take the trade. Now, on a risk management point of view, what has happened? Price has gotten back above the last impulse high that was created right around our signal. That certainly would be a sign for me that I'm going to think about exiting that trade. And in that case, the risk on this trade, I probably would have only lost about $2,000. But let's go back and look at it on our candlestick, our charts, is if price goes above my moving averages on this impulse candle, and it certainly closes above the candle that created the sell signal, those two scenarios would definitely be a risk management where I would say, hey, you know what? I'm going to take this trade off. I'm going to take my lumps, take that loss. Now, if the futures trading guide does not turn positive or turn to a buy signal, still showing a sell signal, I'm still not going to come back into this trade until we do what? We take out that low. Fool me once, shame on you. Fool me twice, shame on me. So now I'm going to wait patiently for price action to go below that low to confirm that I am in a downtrend. But it certainly looks like what we got here was a false signal. Okay. One more real quick. So let's go back to our portfolio. I'm going to go for this one kind of quickly. So here's the 10-year note, and this is where we follow the rules and we do the planning. We wait for the confirmation, and still the system does not work, and that's again part of trading. So here's the 10-year note, and here's the sell signal that was created. And what I'm said is, okay, well, I got a sell signal. Now I'm going to wait for that confirmation. I'm going to wait for price to break the low that was created before my signal. There it is. There's the candle that puts me into the market. Would go to that lower time frame, use that oscillator, look for an entry. The entry was in here somewhere. And then I'm in this trade, right? I've got a little bit greater confidence. But then what does price do? Well, it moves against me, right? And if I go to my 9 and 18, it's now given the crossover, the new buy signal, get out of my short, go long, right? So again, on a risk management point of view here is I did everything right. I waited for the confirmation. I got into the short. The short didn't work, right? And then I got this impulse candle that not only went above both my moving averages, it closed both above both my moving averages, but it went above the impulse candle that got me into the trade, and it went above the candle that created the futures trading guide signal. Again, on a risk management standpoint at this point, I probably know I'm wrong, take my lumps and walk away from the trade instead of waiting for the futures trading guide to signal me out, and that would have happened here. But I did it as the rule. I waited for the future trading guide signal to give me that exit signal, and I put the trade in, and you can see that both the future trading guide and that confirmational entry were losing trades. So system, right? This is part of trading, futures trading, about trend following systems, that they don't always go as planned. Okay. So I want to answer a couple questions. I see a couple questions popping up here, and we're going to get to that, but I want to do one more segment for you before we answer some questions. And let's do this. I got to get rid of some of these. Actually, I got to get rid of all of them, I think. Yep. Oh, one more and one more. There we go. Okay. So I get a lot of questions about, I see a couple of questions popping up here that are related to this subject matter. Something about position size. And I do get this occasionally when I'm doing futures webinars. So how to determine your position sizing, or determine how many contracts that you can trade in the futures market. So there's two formulas that you can use. One is called the market volatility formula. And what we do here is we basically look at a percentage of our total equity, how much is in our trading account, and we're going to divide it by what's called the market dollar volatility. Now, what is the market dollar volatility? Well, I've used the 20-day ATR. Since we're using the 9 and 18, you could maybe use the 9-day ATR, but we're going to times that by the dollar per point value. Again, that was part of that risk management we found on the contract specs page or line in our futures trading guide. And then we divide that into how much we're going to risk or set aside for that trade. Now, the general rule here for most traders is we're going to use about 2% of our equity in this formula. Now, some of you who have a limited amount of capital, if you did this formula and you're using, one of these more volatile markets, you'll get a value that is less than 1. Don't worry. Many of the futures contracts that I've just went through, especially crude oil, especially the equity indexes, offer what is called micro contracts. And these micro contracts are about 1/10 of the size of the regular contracts. So if you get a value that's less than 1, it just means that look to see if you can trade micro contracts. The caveat in there is just make sure there's enough volume to support that trading activity. And a lot of them do have a lot of volume. So for somebody who has a less amount of capital, probably the better rule is what we'll call the margin requirement rule. And in this case, what we're going to do is we're going to set aside a portion of our total equity to cover our margin requirements. And then that's going to help us define how many contracts we're going to trade. So for instance, let's say I have a futures trading account that I have $50,000 in, and I'm going to set aside a percentage for each one of these trades that I'm going to take. And, again, this is just a guideline. Let's just say 1/3. So 1/3 of 50,000 is about 17,000. That's how much margin I'm going to set aside. If I'm trading something like corn, where the margin is around 2,500, that means I could take up to 5 corn contracts. Now, I might not take all 5 contracts at once. I might build into that position, but that would be the maximum that I'll allow myself to take. If I did a trade, let's say in the gold trade, where the margin is around $7,000, then I could only take 2 contracts. So what are some kind of rules that I can use to add on? So again, I'm going to have this base unit that I'm going to take on for a new signal. And again, it might not be my whole basket. Maybe it's just one contract. And then I'm going to add additional units after X a number of days. Again, we're into the long game here. 2 days, 3 days, 5 days. Depends. Depends on the volatility market. Maybe we just wait for those moving averages to turn positive or turn negative, depending on if it's a long or short. But also there's that part of the equation where we wait for the trade to create new profit highs. In other words, in a long, we want to wait for the market to take out one of those recent highs if we're in a short, recent lows. And again, we're going to stop adding to our position when we reach that maximum dollar risk that maybe our plan has defined. So here's some general rules in terms about pyramiding. Again, there's a mix of about rules that I use, but also some more generic rules that you'll hear from a lot of traders. So the first one makes a lot of sense, doesn't it? Never add to a position until that position becomes profitable, right? Don't want to add to a losing position. Place stops at the break even level as the position increases. I think I could have probably wrote this a little bit better as set your stop based on the break-even level, right? Certainly what we don't want to happen is we have a winning trade, we add on positions, right? And then we let that winning trade turn into a losing trade. So I want to make sure that I manage risk based on that break-even level. Enter the largest position first and then reduce size. So in the example, let's say of corn, maybe I would enter 3 contracts on the initial position, and then I look for a 2 position add-on. And never let the position grow larger than the limits that you set based on your trade plan or your system, and that a maximum acceptable position size. Again, I think this is an easy rule to follow. It's going to be based on how much margin you've decided you're going to put towards a trade. So don't break your rules, right? Just because you have more margin available in your account, you've decided that you're only going to put 25% of your account towards margin or 30% of your account to margin. What you don't want to do is end up putting all of your margin in one trade. That is not good risk management. Okay, and there are some different position sizing pyramids styles. So the easiest one is the scale down, right? We have our base unit, and then every additional add-on is about half, right? So in this case, let's say I could afford to take 15 contracts. So I'm going to do 8 on the initial trade. I'm going to do 4, then I'm going to 2, then 1, and that'll get me to my 15 max. We could do equal additions. This is called an inverted pyramid, right? I'm just going to do 10 positions, 10, 10, 10. Now I have a 40 lot position. So you can imagine that it's kind of like a pyramid upside down. And the one that I use, and I think it gives you greatest leverage, it's called a reflective pyramid. Here, what we're going to do is, like our scale down, we're going to use a large value on our first, and then we're going to have as we go down. But on the other side of the arrow is how we're going to unwind this position. So remember when I showed you those high and low lines, flags in our portfolio? And I said, well, hey, why did I pick 1870 in gold? Well, that was where I feel that I would probably want to take a little bit of profit if price started to move against me. Market's already moved in my favor. So what we'll do is we'll take what we call these soft stops. I could take 2 contracts off to protect my profits. A lot of times what I try to do is this first leg off is I also want to try to capture enough profit that's going to pay for risk, which would be really nice if I could put enough profit in the bank into my account that makes up for the risk that in that trade. And then maybe when I reach that second or third or that resistance target, I'll take the other 4 contracts off. And then the last leg off would be when the futures trading guide turns from a buy to a sell or sell to a buy. Okay. All right, so a couple questions I see here. Wayne, hey Wayne, what's going up? Can we use this RSI stochastics for stocks? Yeah, you can use it, Wayne. It's very similar. Um, Jeff asks, do you have any thoughts on using the 9 and 18 moving average in smaller time frames, like 60 minutes? Uh, I I think in terms of um, using these values for 9 and 18 in lower time frames, I think what you want to kind of look for is we want to when we're doing moving averages at, let's say, smaller time frames, it's going to depend on the size of, let's say, your trend time frame or the time frame that you're doing your risk assessment. So let's say for like the stock market where, it's only open 6.5, 7 hours a day, and I'm on a daily time frame doing my trend analysis, well, maybe what I want to do is pick a moving average of these lower time frames that's going to be a little bit more sensitive and pick up a new trend. But I only have 7 hours to define that. So maybe what I might say is, maybe I might use a 3 and 5 or a 6 and 8, something to that align because of the smaller amount of time intervals that are inside intraday market. But I have used the 9 and 18, let's say at the 60 or the 240 or the 4 hour, and it does work. But I really kind of just want to use that in terms of the futures trading guide based on our daily time frame. Okay. Wow. I didn't think I was going to be able to do it, Gene.
You fit it all in within the hour, John. Good job.
All right. So let's do this before I give you one more takeaway. Okay, so just a couple thoughts here. First of all, I did mention a lot of the archived webinars. You can come in here where it says archive webinars, and under futures trading, we have a lot of great futures trading. But here's that one, futures trading market opportunities with a clock. That is how to trade these futures contracts that trade around the clock. For some of you that have limited amount of capital, in there you will learn how to use ATR to help you with your risk management. What was the other one? Oh, here's the futures trading guide. And I think we have another one. There it is. Yeah. So those two go a little bit more in detail. The other one I think I mentioned was, strength and direction. So I think I can just type in strength, right, Gene? What do you think?
Yes, you should be able to search on that word.
If I spelt it right.
If you spelled it right.
Languages. There it is. Trading markets using the strength and direction. All right. So it worked. All right. Next week, we don't have a session. We're going to take a week off to do some planning. I want to tell you that I'm really excited about February. February is going to be an action-packed. We have a lot of great subject matters and maybe a surprise for you. I'm not going to tell that yet. The other thing I wanted to point out is, and Gene, maybe you can talk about this, about the difference between a regular subscription and a premier subscription as concerns the futures trading guide.
Well, as John said, Futures Trading Guide is a premier subscription feature. And if you're not a premier member, we do offer a free 30-day trial. You can go ahead and sign up for that and check out the Futures Trading Guide.
Cool. All right. And also, one of the neat features that we have for premier members is on Fridays, we have a show. It's called Market on Close. So you can go in there and just from our webpage here, watch live streaming. And we talk about a little bit of macro stuff. We talk about some, trading opportunities. And it's kind of a little give and take banner between two traders that just kind of trying to figure out the market. All of our sessions will end up on our YouTube page. And if you're watching any of our archived sessions or this session on the YouTube page, do me a favor and give me a thumbs up or give me just a comment what you like or even what you don't like, or just type in there what you had for lunch. So I would really appreciate that. All right, so I'm looking at my list. I think I got everything, Gene. Did I forget something?
No, I think we're good. Good to go.
All right, great. Thanks for a great session again, Gene. I hope folks you enjoyed this. This is one of our popular futures tools. I think I give you a lot of information how you can use this and also to help you to manage that risk aspect of it. So until next time, be safe out there, the best of health, and the good of all trading.